Good morning, everyone. We'll just sort of let, obviously there's still people who are still joining, but while they do, I will introduce you again for many. I think this is David's, I think, fourth webinar with us, and we were just talking beforehand. I think our last one was on the day that Liz Truss was announced the leader of the Conservative Party, and obviously a few days before the Queen died, and so obviously here we are 6 or 7 months later, and obviously we've got well, not just we had another new Prime Minister, and obviously just before the coronation of the new King. So it's funny how these things sort of go in cycles. But anyway, as most of you, or all of you, will no doubt know, David is the economics editor of the Sunday Times. And has been since 1989, if I recall correctly. The format is as usual for those of you who have joined us before. David will sort of run through his thoughts for sort of 35 minutes or so, and then we'll have sort of Q&A for 15, 20 minutes. We've already had some questions that have been submitted to us before, largely revolving around interest rates and inflation, which is no surprise. But please feel free to submit questions as you go along, and you can do that on the Q&A section, and we will try and cover as many as we can. So with that, I will pass over to David.
Thanks very much indeed. I'm going to put this slideshow up so we can talk about that. And it's great to be talking to you. This is still thank you, John, for that introduction. It's an interesting time to be talking because, as you know, as last September, things are quite uncertain at the moment. Perhaps not quite as uncertain as they were. This was the question I posed on the day that, as John says, Liz Truss was announced as Tory Prime Minister. And the sequence, we're just talking to John about this, was that a few days later we had the announcement of a 2-year energy price freeze, which is quite a big and expensive announcement. And then the Queen's sad death, and then on September the 23rd, of course, the mini budget. And I think in some respects, we're still recovering from the effects of that. You look in the most of the data we've got for the housing market and for the mortgage market still reflects some of that uncertainty that kicked in as a result of that the market chaos that followed that mini budget. So these things do have consequences, and I want to talk as a preamble to my main comments. I just want to talk about the fact that these that events do have consequences. They have longer term consequences than sometimes we think at the time. And I'll also talk briefly about the current banking worries as well. So if we think back to September, of course, some people thought that what we saw on September the 23rd from Kwasi Kwarteng was the greatest thing ever. A lot of positive comments from conservative newspapers, particularly the papers like the Mail, Telegraph, and so on. But we saw quite quickly that there was a powerful sting in the tail. So sterling, over the weekend that followed that unusual, it was the Friday mini budget, sterling fell to an all-time low, just over $1.03. And then you saw the effects in the gilt market and liability-driven investment, but also in the mortgage market. I've never seen the scale on which we saw mortgage products being withdrawn as people adjusted, not just to higher interest rates and the general instability in the markets, but also fears at that time that we'd see bank rate rise to very high levels just to try and stabilize things. So I think you suddenly move from up to 6 or 7% as the expectation for bank rate. And I'll talk a little bit about where we are now on that a little bit later. Things have settled down now. It's a distant memory. It's only a few months ago, and maybe that distant memory was not distant enough for the Conservatives overnight in the local elections. So I think some of the damage they suffered was as a result of what happened last September, October. But things are different now. And I say this is a preamble before I get onto my the kind of outlook I just want to talk about, these are the questions I hope to answer today. Have we avoided recession? How close we are to the peak in inflation? How fast will it fall? Interest rates, I think it's quite likely, it's pretty much priced in that the Bank of England will hike again next week. But is that going to be it, or will there be more of that? And what does this all mean for the housing market, for the mortgage market? So, but before that, I just wanted to talk about, as I say, events and their long-term consequences, just briefly. So we've seen a series of big events in the last 10 or 15 years. Of course, the global financial crisis. We had the Brexit vote, and almost at the same time, Donald Trump launching trade wars, not just with China, but for a time with Europe and Canada. The pandemic, some of us have lived through previous pandemics. None of us have lived through one with quite the consequences that we saw in 2020 and 2021, and of course then the Russian invasion of Ukraine and its effect, particularly on inflation. So just running through those quickly. I think of these as a little bit like the economic equivalent of the four horsemen of the apocalypse. I've been using this analogy for a while, and I was taking part in a pub quiz, and so one of the questions was, what are the four horsemen of the apocalypse? In the Bible, and I think they are they're war, famine, death, and conquest. My four horsemen are the ones I've just mentioned, slightly different, and it goes back to Harold Macmillan being asked what his biggest challenge was as Prime Minister, and he said, "Events, dear boy, events." And I think that's a bit like that for us. It's great for journalists to have events. It's not so good if you're trying to do business and you're trying to you hope that things are going to be on more of an even keel rather than being pushed off course by these regular occurrences. So if we think about the global financial crisis and its economic impact, this is productivity is obviously very important. It's the driver of living standards, it's the driver of real wages. And what we've had, as you will know, since the financial crisis is that what seemed to be assured productivity growth for the UK of 2% a year, through thick and thin, almost no matter what you throw at the economy, we got 2% productivity growth. Since the financial crisis, we've struggled to get any productivity growth at all. And it's quite and the difference in living standards in the level of productivity is now quite stark. If we continue to grow productivity at pre-crisis levels, it will be 30% higher than it is now, and real wages will be considerably higher. You wouldn't be seeing the kind of industrial disputes that we've got at the moment because there wouldn't have been the squeeze on living standards that we've seen as a result of the productivity slowdown. We of course had as a result of this, financial crisis gave us a big budget deficit, not as big as we've seen recently, but also resulted in the Cameron-Osborne austerity. So, and that lasted for a long time. And you could argue that some of the public sector disputes we're seeing at the moment are a consequence of that, as much as the cost of living squeeze at the moment. Brexit vote. I think the big effect of Brexit was the two big effects of Brexit vote. One was that markets and betting markets were expecting a Remain vote. So when it came to be a Leave vote, we saw a big fall in the pound. This was the biggest fall of any major currency in a short period in the floating rate era, which dates back to the early 70s. So a big shock for sterling. And it's remained pretty much where it dropped to since then. There's been no reassessment by currency markets. There were two stages to sterling's fall in 2016. One was on the result itself. The second was a little bit later in the year when Theresa May, who was Prime Minister, said we wouldn't be trying to rejoin the single market or the customs union. So there's a second fall there, and we're still around in those sort of low to mid 120s against the dollar, compared with a long-term average for the 30 years leading up to the referendum of about 165. So sterling is still quite a bit lower than it was. And the other big consequence was that we were seeing quite a decent recovery in business investment in the run-up to the referendum. That tailed off, and you can see it flattens there, falls again during the pandemic, and we're still, only now about where we were in 2016. So we've lost a few years of business investment, which of course has contributed to the productivity slowdown that we've seen. The pandemic obviously the pandemic, it taught us things that we didn't really know were possible. We didn't know that it was possible for a government to lock down the economy, and for a while, as you will remember, shut down the housing market. Housing market was only closed down effectively in the first of the lockdowns, from March 23rd to early May back in 2020. But the effects in terms of the public finances were powerful. We went essentially from pre-pandemic national debt, government debt is 80% of GDP, to post-pandemic it's around about 100%. That's a £400 or £500 billion addition to government debt, which, unlike in this chart goes back a long way, but in the period after wars, and particularly after the Second World War, you can see the sharp fall in government debt from a high level than we've got now, because it was easier to do that. If you demobilize and run down a wartime economy, you can reduce debt, and that's continued for quite some years. But clearly, it's more difficult to do that in the current situation where we've got demographic and other challenges. And also, the consequence of that is, of course, if you've got more debt, if you've got a government which is trying to hold down debt now, just to around about 100% of GDP, you're going to have more taxes. And we're seeing, this is a tax increasing period. Lots of talk about tax cuts from politicians, but in essence, we're seeing business taxes going up. Corporation taxes just gone up, and over the next few years, we'll continue to see income tax and national insurance going up because personal allowances and thresholds are being frozen until the late 2020s, which is probably the biggest stealth tax increase we've ever seen. So again, a consequence of the pandemic. None of this, as you can see from that lower line on that chart, the purplish line there, none of this was expected before the pandemic struck. This is a consequence of the pandemic, which will last for some time. Russian invasion of Ukraine, of course, the final of these shocks. Really high inflation. I don't think, when back in 2020, when the pandemic first struck, it was a bold forecast for anybody to suggest we might get to 5% inflation. 5% inflation was, if you look at this, the highest inflation rates we saw in the post-independence period, which goes back to 1997. We got to 5% in 2008. We got to 5% again in 2011. People thought we might get to 5% again as a result of the pandemic, but nobody, I don't think, thought we'd get much higher than that. And so this is a consequence of this. You could say, and we can talk about this, whether it's a consequence of some of the decisions the Bank of England and other central banks made as well, particularly on QE, quantitative easing. But the upshot is of this that we've had a big increase in inflation, and that, of course, has damaged the Bank of England's reputation. 10%, which we're still at, is a long way from 2%. And even though 2% has been the average since 1997, it's going to take a while before we get back there. And I'll talk a bit more about that in a moment. And the other question, I think, is that, I quite like the four horsemen analogy, and I would hate to have a fifth one because it would ruin the analogy. But we're seeing quite a lot of pressures, particularly on the US regional banks, as as we're reading about every day. Credit Suisse seems to be an exception in the sense that it's had problems for some time, but beginning with Silicon Valley Bank and the other two that have now failed and had to be rescued. I don't think this is 2008 all over again. It doesn't seem to be. It seems to be a consequence of the kind of adjustment that we are seeing, quite widely, which is the adjustment to higher interest rates. Normally, as you will know, higher interest rates benefit the banks. It didn't benefit Silicon Valley Bank because they'd taken a bet on US government bond yields staying very low and lost, they had capital losses because when bond yields went up, the price of those bonds went down. But there is tension here, there's uncertainty here. And in the end, banking, as you know, is all about confidence. If confidence fails, and it has failed for some of these regional banks, then you've got a problem. And I think, while I don't think this is 2008-9 all over again, I do think this is going to have a bearing on lending standards and on the availability of funds. So I don't think we can ignore it as an impact. I don't think it's another major shock, but it's certainly unhelpful in the sense that we'll see tighter lending standards as a result of this. So it's a factor, and it's a factor that we should be slightly concerned about. Not, as I say, I don't think we're going to get banks failing on a big scale. They are better capitalized than they were. We should believe those assurances, but this is not great news that we're seeing these kind of tensions in the banking system, particularly the US banking system at the moment. So what's the outlook? I mean, that's the backdrop. What is the outlook? I think it is undoubtedly the case that the one thing that has come, has really scuppered the prospect of a strong post-pandemic recovery is the Russian invasion. If you take what the IMF was saying at the beginning of last year, of course, it's quite hard to remember that the Russian invasion seems as though it's been there forever, but it's only a year or so. But beginning of last year, a pretty rosy picture for the world economy. 4% is a reasonable number to think of as good global economic growth, and they were pretty close to that, expecting that for both last year and something close to that for this year. And the advanced economies like ours were expected to do pretty well. Again, a long-term growth number for advanced economies will be 2.5%, and they was expected to outperform that as we moved into post-pandemic adjustment. Maybe the sunlit uplands are an element of that. This is the latest picture from the IMF in April. And as you can see, a big downgrade. Last year was not as good as they thought it would be because of the Russian invasion. This year, 2.8% growth is pretty feeble for the world economy. And you look at those numbers for advanced economies like ours, and growth of less than 1.5% a year is pretty weak. And of course, the IMF is quite downbeat on the UK. They don't expect any growth from us this year. They may adjust that, with the next update for these forecasts is in July. But a big downward revision to growth forecasts as a result of the Russian invasion. Russian invasion scuppering essentially the post-pandemic recovery that we were expecting. And it's not hard to see what the problem is, that we've got. We've had the energy price shock, maybe easing now, which is good news. Labour shortages. I don't think anybody expected. Certainly, I used to talk to Rishi Sunak a lot when he was Chancellor, and in particular when the furlough scheme was created. A first for the UK. And the one thing he didn't expect, or anybody else expected, I think, is that we would emerge from the pandemic with shortages of labour. The expectation was that we would, if the furlough scheme could hold down unemployment, let's say, and keep it in single figures, that would be an achievement. Not to emerge from it with serious labour shortages. About the UK labour force is about 1 million smaller than we might have expected it to be pre-pandemic. About 300,000 of that is because we've got fewer EU migrants working in the UK, but some of that is offset by migrant workers from other parts of the world. It's mainly, as you will know, an increase in activity, particularly now among older workers, 50 to 64 age group. And that doesn't seem to be going away. A lot of it is driven by ill health and so on. But that was unexpected. Supply chain problems, I think they are definitely easing now, but have not completely gone away. And of course, as I'll talk about a little bit more in a moment, central banks are tightening policy. So they're tightening policy into what would have been, I think, a stronger recovery. And again, this was not expected much before the Russian invasion. I think if you'd said to people, where is, for example, bank rate going to be? I don't think many people would have expected bank rate to be 4% plus by now, in the absence of this inflation shock we've seen. The UK is just about. It's taken a while to get back to where we were before the pandemic, and of course the scale of, I say, we haven't seen lockdowns before, we've had pandemics before. The scale of the falls we saw during particularly during that first lockdown, were off the scale. A near 20% fall in GDP in the second quarter of 2020 compares with the biggest fall we'd seen before that was in the 3-day week in 1974, which was 2.7%. So, when you prevent a lot of economic activity, you're going to get these falls. And I think we would have expected, rather a quicker bounce back than we've seen, because, in essence, if you stop economic activity happening, you're going to get a fall. If you allow it to happen again, you should get a rise. But some things have not quite come back, so consumer-facing services are still down on pre-pandemic levels, and now things are settling down a bit in the housing market, for example. And many of the things we would look at, like transactions and mortgage approvals, are not back to pre-pandemic levels. So it's not a complete recovery, even though GDP is just about back to where it was. The bounce back was quicker. It was very quick in the US. The US economy bounced back very quickly from its pandemic falls. EU overall was a bit before us, but it's again, the thing that has given us not the perfect V-shaped recession recovery here, but a little bit more turbulence, has been the Russian invasion. Now, consumer confidence, I think this is a very interesting thing, particularly for you in the housing market, because this is a measure of consumer confidence run by, as you can see here, a firm called GfK. It's been run since 1974, and although it has started to recover now, the readings for consumer confidence, I think there is a housing market element in this, the readings for consumer confidence over the autumn and winter were the lowest that this survey has ever recorded. So lower, you think about that, it goes back to 1974, lower than during the pandemic, when we didn't know what the health consequences were going to be, let alone the economic consequences, lower than, during the financial crisis, 2008-9, lower than during the 1970s, when we had briefly, 27% inflation, and lower than during the 1980s and early 90s, when we had more than 3 million people unemployed. So people were very downbeat over the autumn and winter. Confidence did evaporate. As I say, it's coming back a bit now, but it's still pretty weak. And if you're looking for an explanation of why it's weak, I don't think it's hard to find, because this is from the Office of Budget Responsibility, the OBR, and it just shows that we're in the middle of a 2-year fall in household real incomes. Sometimes you get household incomes falling for a year, and we saw that in 2022-23, the fiscal year then. But to get 2 in a row is quite something. And combined, this is comfortably or uncomfortably, perhaps I should say, the biggest fall in household real income since these records began in the mid-50s. And as you can see on the right-hand side there, it will take a while before we get back to where we were in terms of household real income. So people feel squeezed. The squeeze is genuine, and that, I think, is why consumer confidence has been so depressed. Business confidence is on pretty much every measure bouncing back, and has, if you're optimistic about this, and I'm not pessimistic about it, you would say that businesses are anticipating a recovery in consumer confidence, which has started now and may continue for some time. So businesses are reasonably upbeat. For a time, as you can see on here, they were as downbeat recently as they were during the pandemic, particularly after that mini budget I was mentioning earlier. But things have picked up quite a lot now. So I think businesses are much more confident about the outlook, and that is a positive development. We've got, of course, the 2 chancellors now running the country, and that has been positive. I think in terms of you don't anymore think about, as I think perhaps we did when Boris was Prime Minister, and the brief period when Liz Truss was Prime Minister. You don't anymore switch on the news and think, God, what have they done next? It's politics has become, it's not boring today for the parties, because they've got the local election results to digest. But you don't think that the government is going to have done something really silly again. It doesn't feel like that with these two in charge. And you can see that sterling has recovered from its lows after that mini budget. It's no great shake, sterling in the mid 120s, but it's better than it was. And no longer have we got what we had in the autumn, a falling pound driving inflation even higher through higher import prices. So that is a positive. And there's a general air of greater stability around, I think, and that is positive. So I think, looking at it broadly, it looked quite likely. And I think you should, economic forecasters get a lot of flack about things like this, but they can only deal with, the information they've got. And the information that forecasters had late last year, and forecasters like the Bank of England had late last year, was that we were still going to see an even bigger hit to household incomes as a result, and to businesses as a result of high energy prices. I mean, you will remember those forecasts from people like Cornwall Insight, who were saying that the average household energy bill could go to £5,000 a year in January, maybe £6,000 a year in April. And you put those numbers in, and it would have been devastating for the economy. So it wasn't surprising that there were lots of recession predictions around at the end of last year. They weren't. I don't think anybody was predicting that we'd have a big recession, because big recessions, that they're not like London buses. You don't get two coming along at once. So we had a really big one in 2020, biggest since 1709. So you weren't going to see another big one, but it looked quite likely, given what appeared to be the outlook for energy prices and for gas prices then, that we would see quite a big hit to business activity and to consumer spending. But that hasn't occurred, and so I think we're still, we're not in a great position. We still, as I say on this slide, have a problem in terms of longer term growth, and of course in productivity, the slide earlier. But I think it's unlikely that we'll get a recession now. We seem to be in a better place on that now. Lower gas prices, that's been the big helpful effect. Lower gas prices, lower oil prices. This has been a classic energy price spike we've seen. Not something that was going to go higher and higher, but something that the spike in energy prices and gas prices, as you can see here, is now quite some time ago. So that's been a big positive factor, I think. So no longer is the outlook for recession. You look at surveys like the Purchasing Managers surveys, the PMIs, again pointing to growth, which should have occurred in the first quarter. We'll get the figures quite soon, but also slightly stronger growth once you take out the coronation effect and the loss of a working day in the second quarter. So we seem to be through the worst. We're through the worst in terms of recessionary pressure, I think, even at a time when, curiously enough, you look across at America, and some of the readings there are more troubling, I think, than some of the readings you're getting for the UK and Europe, even though America was not so much in the firing line when it came to, or wasn't so much hit by rising gas prices as we were. We were vulnerable to rising gas prices because we are acutely dependent on gas. More than 40% of our primary energy comes from gas, which is higher than most countries, including most countries in Europe. But things are looking better. Things are looking up. And so I think we should be positive on that. I think the growth outlook is better. We're not going to see any great shakes in terms of growth this year, but it won't be, I don't think, a recession. We shouldn't expect a recession. Inflation, of course, is the problem. And I think I remember waking up a few weeks ago. It must have been before the February CPI was released, and the headlines on the Today program or on Times Radio, I listen to both, of course, were that figures to be published shortly will show inflation dropping back into single figures, and of course it went up to 10.4%, come back a bit now to 10, but only 10.1%. So inflation has stayed higher for longer than was expected, and has stayed high even though most other countries, including the US, where it's down to about 5%, including the rest of Europe, where it's coming down quite sharply. So this is this has been not necessarily a national embarrassment, but a problem that it has echoes of us being vulnerable to high inflation, more vulnerable to high inflation than other countries. But I think we are on the cusp of it coming down quite sharply. I mean, these forecasts, this is the OBR forecast, but these forecasts would have to be incredibly badly wrong for for us not to see a big fall in inflation over the next few months. So I think and of course the government set itself a target of halving it by the end of the year. I think that is going to happen, but I think we need to look at the details of that. One of the things that has undoubtedly been more of a problem than was expected has been food price inflation, which is still very high, may still have further to rise. But the other one is, how much have we got high core inflation? If we'll get a fall in inflation because of base effects, comparisons with a year earlier, particularly on energy prices. But will we get a fall in core inflation? Will we get a fall in service sector inflation? I think that is the issue that's going to trouble and occupy the Bank of England's thoughts. How much will it permanently come down? The forecast will be for a sharp fall over the next couple of years, getting back down to 2% or below. And that's what the bank will say next week. But, can it keep it down there? What is underlying inflation? And in particular, what is underlying inflation once you've lost the helpful China effect? The China effect for the past 25, 30 years has meant that we've had no goods price inflation. All the inflation we've had pretty much has been service sector inflation. Once you get rid of that China effect, it's less powerful now. Can we keep inflation down to 2%? I think the answer to that, by the way, is that it will mean that we won't go back to the kind of interest rates that we saw between the financial crisis and last year when we didn't go above 1% for bank rate. I think we're going to settle down at a sort of positive real interest rate. So, 4% or so is, 3 to 5% you should think of as the normal range, I think, in future for bank rates, not 0 to 1%. It could have been worse for inflation. Without that energy price package that Liz Truss announced on September the 9th, we could have been looking at 13% inflation over last winter, according to the Bank of England. And many people thought it would be higher than that, 15, 18% inflation. Had we got to anything like that, I think it would have been very difficult to hold the line. I think, 10% is bad enough, 11% was bad enough, but 13, 14, 15, 18% inflation. I think at that point you've kind of lost it really. And so it was a necessary intervention to keep energy bills down and to prevent things from happening. That would have been pretty serious, I think. And I think apart from the energy price thing, one of the things we haven't seen in terms of inflation is the wage price spiral. I mean, I mentioned earlier on that in the 70s we saw briefly at 27% inflation. In that year we saw 27% inflation, which was 1975. We had 30% growth in wages and salaries. This time, as you well know, wages and salaries have risen, but they haven't kept up with the high inflation we've seen. We're not seeing the kind of old-fashioned wage price spiral. And for those of you who believe in the money supply matters, then money supply was expanded a lot as a result of QE, but now that has gone into reverse. And if you look here, money supply growth, this is the broadest measure of money supply, is now negative. So if that tells us anything about future inflation, it should tell us that we're heading for a fall at least over the next year or so. So I think we can be positive about that. What about interest rates? I know you're interested in that. And to channel Sherlock Holmes, this interest rate dog has been barking a lot over the past 12 months or so. We've seen bank rate go from 0.1% to 4.25%. And this is, this long period. I mean, the long period between, March 2009 and actually May last year, when bank rate was never above 0.75%. The worry you have when looking at the economy and looking at the housing market is that too many people thought that was the norm and acted accordingly and overborrowed accordingly. That would be the worry. Never expecting rates to go up to the extent we've seen rates go up. As I say, it's pretty likely that we'll get another increase. It would be a surprise if the bank did not raise rates next week. But I think that should be, I'm not certain that that's going to be the peak of 4.5%. It could be that if inflation is stickier for a little bit longer, the bank will want to reinforce its move towards that. But I think we're very close to the peak. at 4.5%. I thought the peak would be a bit lower. And in fact, I think it was in March, the Bank of England suggested that we were pretty close to the peak. So but I think we're very close to it. So, but let me run through quickly, and I can see John there.
Just a quick question, actually. Yeah. Can I just ask a quick question on that point, actually? Because it's a relevant point to ask it. It's not so much when they peak, but certainly not where they peak, but certainly, earlier in the year or certainly end of last year, the general consensus was at some point post-autumn in 23, we'd actually start to see some interest rate cuts, as in they'd be peaking around about now, come September, October, or maybe November, then they'd start to fall down. Now with kind of obviously combination of inflation being more stubborn, and obviously it doesn't look like we're going to have a recession, that now looks sort of more unlikely now that actually we can't really expect any cuts this year, you'd say, and then actually any cutting is going to be till 2024.
Yes, John, that's a very good point. I think the interesting thing about that is that pivot argument about moving from raising rates to cutting them is still live in America, and there are quite a few people who think that by the final quarter of this year, the Fed might be starting to cut rates. I don't think anybody really thinks that is going to be the case here, and I think it's because, or in Europe, the European Central Bank, and I think that is because, particularly for the UK and the Bank of England, I think this has just been such a profound shock, and it's a bit like I think they will be very reluctant to relax and risk inflation coming back before they are absolutely sure that it is on the way down, and at least going to stay down for a couple of years. And one of the reasons for that, I think, is that they're still, the Bank of England is almost obsessive about the labour market and about pay. And the one reason I don't think they'd want to cut going into, towards the end of this year, and certainly not until beyond the spring of next year, will be that they want to see how next year's pay round turns out. I think one of the things they're worried about is catch-up pay increases from the squeeze that we've seen now and the fall in real wages. So I think the markets are probably right on that in the sense of not expecting any early pivot to cuts from the Bank of England. I'll just say some quick words about the housing market, and then we can have some questions if that's all right. So we've seen house prices falling, and this is the nationwide measure, which has got a bigger fall in house prices than most of the others. Nationwide's down about 4%, but the latest reading, as you will know, was slightly up, and not for the first time. Halifax and Nationwide are showing a slightly different picture on a month-to-month basis. Transactions a little bit weaker than they were, still, not devastatingly weak, but compared with maybe the glory days that people remember for some time ago, not as many housing transactions as we used to have. Stamp duty and all those things probably factors here. Mortgage approvals, I didn't have time to put on this chart yesterday's approvals, which are up quite strongly to more than 50,000. But the average, I suppose the norm, you can see it on there, pre-pandemic rather, was 60 to 70,000 monthly mortgage approvals. So we're still some way below that. So, but I think, and I was saying to John earlier, I think the story of the housing market has been one of adjustment, not just to higher interest rates, higher mortgage rates, but to the shock of last autumn and the sudden, people realizing maybe for the first time that this was a different environment, and some of that shock from last autumn, I think, is now subsiding. So things looking ahead, I think, are a little bit better than this. But the fundamental point when I look at the housing market is that we've seen for years and years that the one measure of affordability, the house price earnings ratio, has just gone up and up, but housing was kept affordable by very low interest rates, very low mortgage rates, so people could afford the monthly payments. First-time buyers could afford the monthly payments. Once you move to a higher normal level of mortgage rates, then you're taking that second compensating factor away. So that then it becomes, an adjustment was necessary. The adjustment could come just simply in the form, and I think that's probably what we will see, in the form of prices not falling very much, house prices not falling very much, but the house price earnings ratio adjusting because earnings are rising 6 or 7% now, and if house prices are flat to slightly down, then that measure of affordability improves. But it is an adjustment. It's an adjustment that has to take place. Mortgage rates, as you see here, this is nationwide from the Bank of England figures, down from where they went up to after that mini budget. So that is good news, but I don't think they're going to come down much more. And of course, it depends on loan to value and so on. But low unemployment, I think, is still a supportive factor for the housing market. One of the things I mentioned, consumer confidence is very weak, but certainly in that consumer confidence index I showed you, unemployment, loss of jobs is not yet a factor. People are not worried about that in the way they were in the past. You need, I think, for a really big housing correction to happen, you need high unemployment, you need forced selling, and we're not seeing that, and I don't think we will see that. So as long as unemployment stays low, as long as people are realistic about what they can afford in this new mortgage rate environment, I think the housing outlook is not as bad as it's much better than it looked a few months ago. It's much better than it looked a few weeks ago. I think we're going to make some progress this year rather than go into reverse. So it's stabilizing, I think, after the autumn shock, and consumer confidence is now on the up. And businesses expect consumer confidence to improve further. So I think that is good news. And we have got a very resilient housing market. I think we've seen that in spades over the past couple of years. So I don't think we should be too gloomy about the housing market. Not much of a correction. A correction, but a modest one, I think, is my verdict. We have to hope there's not too many further shocks and surprises, particularly affecting the banking system. And just finally, as I always do, I'll just update you on my skip index. And the skip index, for those of you who have ever seen me talk about it before, it's based on the number of builder skips in my street. When there are none at all, we've got no growth, we're in recession. When there are two, we're growing in line with trend growth, and that's as good as it could be. When there are four, it's an unsustainable boom. And as I may have told you before, the pandemic played havoc with the skip index. For a while, nobody wanted to build near their house because they feared catching COVID from them. So we had no skips in the street. Then everybody wanted a home office or a loft conversion because they thought they were going to be working from home forever. And so at times we had more than 4 skips in the street. But now it's settled down. And when I did a count last night, there are 2 skips in the street. So I'm not saying things are perfect, but they're better than they might have been. So I think the outlook is better. The housing outlook is better, and I'm just mildly optimistic about things. I think it's better than it looked even a few weeks ago. Thanks very much, John. Look forward to the questions then.
Fantastic. Thanks so much for that. There. We've got quite a few questions. We'll get through as many as we can in the next 10 minutes or so. But first of all, one about labour shortages. So I think you wrote about it in the Sunday Times just after the budget. Obviously, one of the targets for Jeremy Hunt's budget was to these various back to work incentives, et cetera, to try and encourage people to. If I remember rightly, you were quite sceptical that they were going to do much. Is there anything they can do? Is there any sign that there is working, or is it really there's not much we can do on that front? And we're really, if we're looking at that, we're really reliant on migration labour as opposed to people returning to work.
Yeah, I think the one thing that has happened, it was completely unrelated to any of those things that Jeremy Hunt did, which is that young people, 18, 24-year-olds, some of those extended their education or period in full-time education as a result of the pandemic. Maybe because they missed stuff, maybe because they wanted another year at university or something, and that seems to, and also those that were in full-time education, fewer of them had part-time jobs in hospitality and so on. But that seems to be unwinding now. So from that bit of the workforce, inactivity is falling. There's more people coming through into the labour market. But for the older workers, I think once, if you've decided that you've got ill health, you've got health problems, if you've decided you've got, you've retired, it takes quite a bit to bring you back into the workforce, I think. And, particularly, I think some older workers are sort of a little bit, fearful of technology and maybe all the things that we rushed through during the pandemic, which is lots more of the kind of thing we're doing now. Maybe a lot of older workers didn't like that. The one thing I think is quite positive that you could do to increase labour supply is, again, as a result of the kind of thing we're doing now, for people who are out of the labour force because they couldn't commute, they couldn't travel, people who've got health issues, disability issues, and so on. If it's possible to work from home, and if more people can work from home, then you might be able to increase the labour supply that way. But I think if you're talking about things like, builders, workers in hospitality, and quite a lot of skilled trades as well, skilled occupations, I think we are talking about migration there. And we are seeing a lot more migration from the rest of the world compared with the EU. But EU workers did fill quite important gaps in the labour force, and they won't be doing so in future, I don't think. You're seeing a lot of those countries from which we got migrant labour. Now their own living standards have improved quite a lot. So there's no great incentive to come to the UK as there was in 2004.
Yeah, that makes sense. And this is a sort of general question, and that someone's asked is, and it's, I think, a very valid point actually, that about actually the reliability of economic forecasts. Obviously, no one really saw inflation coming, and obviously everyone expected us to go into recession. Obviously, a pandemic by definition you couldn't really forecast, but we've got things, not just whether it be the Bank of England, whether it be the IMF, we've got things pretty badly wrong, if that makes sense, in the past.
Yeah, we have. I mean, if you go back to the start of the pandemic and the response to it in March 2020. I mean, one or two people did say, well, all this QE that the Bank of England is doing is going to give us high inflation because, and I think we'd look back at that and think it was a misdiagnosis. That they respond. Their response to the pandemic was straight out of the financial crisis playbook. Do lots of QE, cut interest rates to the lowest possible level. And when you have a supply shock, as we did, that was the wrong thing to do. But on economic forecasters, you can make a temporary name for yourself as an economic forecaster by predicting something that nobody else is doing. And anybody who predicted 10% inflation at a time, because I think even Tim Congdon, the monetarist economist, only thought the UK inflation would go to about 5%. And then we had the Russian invasion on top of that. But I think it's forecasts are determined by the past. So and I remember looking at the work that was done on the impact of pandemics, and there'd been some good work done. And it was because all the pandemics we'd had before in the UK were flu pandemics. People looked at that, and they looked at the main economic intervention they expected was going to be school closures rather than businesses being closed more generally. And they thought there'd be a 5% hit to GDP as a result of a pandemic. Of course, it was much bigger than that, and because you couldn't predict what the nature of the pandemic would be and what the policy response would be to it. But I think, it's reasonable. The purpose of economic forecasts, most of the work economists do is not to do with forecasting, but the purpose of forecasts is to just say, you need to look at the assumptions. If you disagree with the assumptions, disagree with the forecast. But we were. I was at an event recently commemorating Alan Budd. Alan Budd did lots of jobs, including government chief economic advisor. He was on the MPC and so on. He died recently. And he used to work at the LBS, London Business School. And we at the Sunday Times carried the London Business School forecasts for a long time. And I was saying at this event that people used to think there was something mystical about economic forecasts. These guys sitting around a cauldron and they just couldn't pick out numbers and so on. But forecasts are only as good as the assumptions that go into them. And as my colleague Owen Stelzner on Sunday Times sometimes says, forecasters only use decimal points to show that they got a sense of humor. It can never be as precise as that. So look at the assumptions. If you disagree with the assumptions, disagree with the forecast. But I think they're also quite useful for business, because if you do that, don't just read the news story about the forecast, but look at some of those documents that are produced by the OBR and the Bank of England, which are very detailed and very useful. I know time is precious, but it's quite a useful tool to see where you can disagree and where you can possibly do quite well from disagreeing with some of the assumptions.
And then one thing that we saw, I think, both from the Bank of England figures, but also the banks that reported Q1 numbers, was obviously savings levels are down, or there's been some element of deposit flight. And I saw obviously Simon French, I think on Twitter, I don't know if you wrote it in the Times, but sort of he sort of took a view that actually this could be seen as a positive, with people actually, are people actually spending more money? They're now actually drawing down savings. Is that your view, or is it? I mean, I know it's a one-off at this quarter, so we can't necessarily say it's a trend. But can we take some comfort there that maybe consumption is holding up, people feeling more confident if they're drawing down on savings?
Yeah, I think so. I mean, on the face of it, for the first time in a long time, people have got some incentive. I know we're still talking about negative real returns, but from nothing to 3 or 4%. People have got a return on their deposits now. But, one of the big questions was, what would happen to those involuntary pandemic savings? They're involuntary because people couldn't do the things they normally do, So, nice things like going on holiday, going out, eating out, entertainment, and so on. If you couldn't do that, you built up, some people built up surplus savings. And there were a lot of those, 200 billion or so. And one of the big questions about the economy was what would happen to those? Would they just stay as savings, or would they be gradually run down? I think the fact that some of them are being run down is quite good news, as Simon suggested, because in one sense they may have been run down to get people through the winter and the cost of living squeeze. But if that then moves on to being spent on other things, I think they are being spent on other things. One of the things we're seeing is a shift from, goods. We're able to buy goods during the pandemic from Amazon. So now people are buying experiences. Holiday bookings are high. Restaurant bookings are good. People are getting out more and traveling more, and that is positive. And consumer-facing services are still down on pre-pandemic levels, but they are recovering quite fast. So I think that is good news. It's a return to normality. So I don't think we should regard that as bad. I mean, one thing, and I think we were talking about this, John, is does it create funding problems for the banks? I don't think it does, because they had so many of these surplus savings, just sitting there, and to see them drop a bit is not, I don't think, that troubling. It's something they might have expected to happen, a few months ago. So it's, I don't think it's going to add to, the difficulty. I don't think it's going to create funding difficulties for the lenders.
And then finally, one that's sort of slightly political, really, is obviously just thinking ahead to 2024. I mean, broadly speaking, the UK and the US election cycles are going to coincide with obviously a presidential election in October, November, and the UK one, I suspect, is likely to be at some point either in the second half of next year or very early in January 25. So in both sides of the Atlantic, we're going to be on election footing, and I suspect could be changes of governments on both sides. What's your view to how do you think that potentially feed through into economic behaviour next year when there's, regardless of who might get in, because obviously there's we don't know who's going to win on either, or maybe in America even who the candidates might be, but is that going to have any impact where people are just sitting and waiting to make investment decisions, both here and the US, and whether that just feeds through into the economy?
Yeah, I think it will a bit. I mean, I don't know how Americans will, an American business will view, the prospect or the risk of a return of Donald Trump, because in essence, as with as the same with Boris Johnson. If you've been through that once, and that kind of having to keep an eye on the news every hour and wondering what that news alert is coming through because you don't know what they're going to do next. It's the same with Trump. You don't know what his next tweet is going to be. And you remember in those early days when he first became president, he targeted specific American businesses in his tweets. If somebody was planning to build a plant in another country, Mexico or somewhere, he would attack them. So it did have and sometimes that had a meaningful market effect. I think people would be very uncertain about that. The trouble with I don't think it is quite as strong there, but in America, it could be a choice of two things that neither of which people want. They probably don't want necessarily a very old president to be re-elected, but they probably don't want Trump either. So I don't know how that will come out, but it will have an effect. I think in this country, Labour has done its best, as it did in '97, to make sure that the business does not have too much to fear from it. And I think that is probably genuine. I don't think there is any Corbynism hiding behind what Keir Starmer and Rachel Reeves say. So I think they're going to be sensible. They've been on the what we used to call the prawn cocktail offensive with the city and business, and they've reassured people. A lot of businesses I talk to, I think would probably want a change of government, because I think even if business people are instinctively Tory, they can sense that the Tories need refreshing, both on the backbenches and in terms of cabinet ministers and so on. And I think a period in opposition might do the Tories some good. I don't what it would mean for people like Rishi Sunak and so on. And if he lost the election, I don't know. I don't know how it would fall. Who would be the next leader and so on. But I don't think an election itself is going to stop businesses investing in this country, UK businesses. I think they would view it as something that maybe a change of government is going to happen, but they can live with it.
Fantastic. Well, thank you so much for joining us, David. Over the last hour, we've covered a lot of ground, as you usually do. We've got through, and I suppose the very simple summary is sort of mildly optimistic, I suppose. Is that a fair summary?
It is, yeah. And I noticed we've got a lot of Q&As in there. If anybody wants to email me with a question, my email address is, I'll give you my email address, david.smith@sundaytimes.co.uk. Happy to answer any unanswered questions from people. So, but it's been nice to talk to you. Thanks very much, John.
Fantastic. Thank you very much, David. Thank you everyone for joining us, and have a good